Welcome back to the channel, everyone. Today I want to talk about the biggest problems with the SEC and why the SEC is currently failing us. So stay tuned and let's make some money. But before I dive into the video, I just want to give a massive shout out to the team over on the private Discord. There they get urgent news, due diligence and updates about AMC, other stocks and cryptocurrencies as well. And they get access to all of my live, real-time trades, linked in the description below. And now I want to dive straight in with the key information. So, talk is cheap. The trust issue we have with the SEC and Gary is the classic give an inch and take a mile. You go on TV and you say a bunch of stuff, right? Try and smooth things over a little bit. Give some reassurance that our tax dollars are at work. But then you spend my tax dollars on stopping 2-bit Ponzi schemes running a little over $100 million. But you look the other way while Kenny G racks in up to $1 trillion or over $1 trillion in reverse repos and blatantly uses an algorithm, on top of an absolute conflict of interest as a market maker as well as a hedge fund manager. He's also allowed to completely and on record abuse the dark pool, to route nearly 65%, sometimes 70% of all orders into the dark pools. Also, he can cheat the tax-paying Americans who are investing in a company they believe in. You let it happen every day at our tax dollars' expense, and then you expect us to trust the process. Should the people who lost their homes and jobs in 2008 have trusted the process? Talk is cheap, Gary. TikTok. And all of this is just amplified by some of Gary Gensler's recent tweets. We've just put out a request for comment on digital engagement practices, like gamification and robo-advising. So Gary Gensler is currently focused on robo-advising compared to all the illegal manipulation and abusive short selling that's currently going on right under their noses. We'd love to hear how you use these tools and what you'd like to see at the SEC. Well, I mean, everyone's been commenting on his tweets every single day since he joined Twitter to investigate AMC, the dark pools and the abuse of short selling, and yet, as far as we're aware, he hasn't done anything. And he said, read my full statement at today's request for comment on digital engagement practices here. I'm interested in the answers to the many questions included in the request for comment, but I'm particularly focused on policy questions about how we protect investors engaging with technologies that use digital engagement practices. And here's a comment that explains absolutely that from Unusual Wales. Gary, I like listening to retail. You know some of their other concerns? GameStop and AMC restrictions, dark pools and frank market manipulation. They want to know you will act, not just poll. The game has begun. And comments like this have been left on Gary Gensler's tweets every single day since he joined Twitter. And not to mention the countless number of requests that we've submitted on the SEC website. I also wanted to bring this to your attention with possibly the best article that I've ever read. Sadly, but not surprisingly, many continue to derisively dismiss the existence of rampant and illegal naked short selling of AMC, GameStop and other publicly traded stocks, and the related printing of hundreds of millions or more of synthetic shares. These folks who have clamped their thinking facilities in an ironclad vice of denial against what they wrongly believe are tinfoil hat conspiracies of the apes might want to pry open their closed minds by reading this. Wall Street's Naked Swindle by Matt Taibbi. I think Matt Taibbi, contributing editor to Rolling Stone magazine, accomplished author and media personality, is a rock star journalist, an opinion that isn't exactly music to the ears of many on Wall Street. In this article, Mr. Taibbi shares his fascination and utterly depressing insight into the twin, this word, of Bear Stearns and Lehman Brothers, erstwhile behemoths on Wall Street. Mr. Taibbi writes, when Bear and Lehman made their final leap off the cliff of history, both undeniably got a push, especially in the form of flat-out counterfeiting scheme called naked short selling. Wow. The roots of short selling, the old chaotic paper runner-based settlement system, the establishment of the DTC to facilitate electronic trading, and the resulting explosion of legal and illegal short selling. The parallel explosion in naked short selling and how the establishment of the DTC made fail to delivers possible and rampant. The startling fact that PIL, payments in lieu of dividend, could be evidence of the crime. Cough are the CEOs of AMC and GameStop paying attention. The nuts and bolts of naked short selling, a 2005 passage of Regulation SHO to counter naked short selling, which was toothless and a timid measure. How Patrick Byron, CEO of Overstock, was turbo-fragged by the mainstream media as a tinfoil hat lunatic for his fight against naked short selling. Sound familiar? the unholy nexus between the rise of prime brokerages and naked short selling, and the role of market maker firms and option trading in this whole mess. Now, the title of this article is Wall Street's Naked Swindle, a scheme to flood the market with counterfeit stocks which helped kill Bear Stearns and Lehman Brothers, and the feds have yet to bust the culprits. Now, I think this sounds all too familiar with AMC and GameStop. On Tuesday, March the 11th, 2008, somebody, nobody knows who, made one of the craziest bets Wall Street has ever seen. The mystery figure spent $1.7 million on a series of options, gambling that shares in the vulnerable investment bank, Bear Stearns, would lose more than half their value in 9 days or less. It was madness, like buying 1.7 million lottery tickets, according to one financial analyst. Because at the time, nobody knew that Bear Stearns was vulnerable. It was one of the largest investment banks in the world, and was absolutely fine and was in no danger of going under. But yet somebody placed a bet with an option that had literally a week and a half till expiry that Bear Stearns was going to drop by 50%. And what's even crazier is that the bet paid. At the close of business that afternoon, Bear Stearns was trading at $62.97. At that point, whoever made the gamble owned the right to sell huge bundles of Bear stock at $30 and $25 on or before March 20th. In order for the bet to pay, Bear would have to fall harder and faster than any Wall Street brokerage in history. The very next day, March 12th, Bear went into a free fall. By the end of the week, the firm had lost virtually all of its cash and was clinging to promise of straight aid. By the weekend, it was being knocked to its knees by the Fed and the Treasury, and forced at the barrel of a shotgun to sell itself to JP Chase, which had been given $29 billion in public money to marry its hunchbacked new bride, at the humiliating price of $2 a share. Whoever bought those options on March the 11th woke up on the morning of March 17th, having made 159 times his money of $1.7 million, or roughly $270 million from one options bet. This trader was either the luckiest guy in the world, the smartest person ever, or what? That this brazen case of insider manipulation was so obvious that even Senator Chris Dodd, chairman of the pillow soft touching Senate Banking Committee, couldn't help but remark on it a few weeks later, when questioning Christopher Cox, the then chief of the Secretary and Exchange Commission. "I would hope that you're looking at this," Dodd said. "This kind of spike must have triggered some sort of bells and whistles at the SEC. This goes beyond rumours." Cox nodded sternly and promised yes, he would look into it. What actually happened is another matter. Again, the SEC turning a blind eye, just like they're doing right as we speak with AMC and GameStop. Although the SEC issued more than 50 subpoenas to Wall Street firms, it's yet to identify the mysterious trader who somehow seemed to know in advance that one of the 5 largest investment banks in America was going to completely tank in a matter of days. I've seen the SEC send agents overseas in a simple insider trading case to investigate profits of maybe $2,000. But they did nothing to stop this massive $270 million profit from betting that one of the 5 largest investment banks was basically going to go bankrupt in 9 days. Now, where it really gets juicy is where the article talks about Bear Stearns and naked short selling. Bear Stearns wasn't the kind of company that had a problem with naked short selling. Before March the 11th, 2008, there had never been a period in which significant quantities of Bear stock had been sold and then not delivered, and the company had never shown up on the regulation SHO list. But beginning on March 12th, the day after the Fed meeting that failed to include Bear and the mysterious purchase of the options betting on the firm's imminent collapse, the number of counterfeit shares in Bear skyrocketed. The best way to grasp what was happening is to look at the data. On Tuesday, March the 11th, there were 201,000 shares of Bear that had failed to deliver. The very next day, the number of phantom shares leapt to 1.2 million. By the close of trading that Friday, the number passed 2 million. And when the market reopened the following Monday, it soared to 13.7 million FTDs. In less than a week, the number of counterfeit shares in Bear had jumped nearly 70-fold. The giant number of undelivered shares over the course of that week amounted to one of the most blatant cases of stock manipulation in Wall Street history, for Bear Stearns of all companies. There is not a doubt in my mind, not a single doubt, that naked short selling helped destroy Bear, says Senator Ted Kaufman, a Democrat from Delaware who has introduced legislation to curb such financial fraud. Asked to rate how obvious a case of naked short selling Bear was on a scale of 1 to 10, the former SEC counsel Brent Baker doesn't hesitate and says, easily a 10. I wonder what rating he'd give to AMC and GameStop. I imagine it would also be easily a 10. Lehman Brothers then saw the exact same thing a few months later. So there was the same blatant manipulation in some of the largest financial institutions and some of the largest funds in history, and yet the SEC just kind of turned a blind eye and looked the other way. There was even more failed delivers in Lehman Brothers and Bear Stearns than we've seen in AMC, and yet the SEC just simply didn't care. The SEC let them get crushed and let people make millions and billions of dollars and did no investigation, or did an investigation but didn't find anyone guilty, and yet they'll go overseas and find someone guilty of $2,000 worth of fraud. And I personally think this is the biggest failing of the SEC. Talk is cheap. Gary talks a lot and he says he's going to do all these things, but he hasn't followed through. Also guys, I wanted to explain and guide you through the deposit process with my new partner, Moomoo. If you haven't already signed up to Moomoo, I've got a link for it down in the description below. But I've noticed some of my subscribers are struggling to deposit, so I wanted to make this tutorial. I also wanted to explain how you can use Moomoo to not only buy stocks on the US stock exchange like the NYSE and the NASDAQ, but also on the Hong Kong stock exchange as well. So the first thing you want to do is go into your Moomoo app, go down into the Me section, and then once you've opened your account, you'll be able to deposit either by ACH or by wire transfer. An ACH is just a direct deposit, so it's very easy, there's no fees, it's very quick, and it's super straightforward to link Moomoo with your bank account. Moomoo, which is owned by Futu Holdings, is also fully integrated with Plaid, as you can see there. So it's super encrypted, it's super safe, and you don't have to worry about your passwords or your data being stolen or lost. So all you need to do is scroll down, find your bank account. Let's say, for example, you're using Bank of America. All you do is select Bank of America, input your username and password, and away you go. And don't forget, it's integrated with Plaid, so it's very, very safe and secure. In addition, if your bank isn't listed with Plaid, you can also enter all of your details, and there's a very simple step-by-step guide to link your bank account with Plaid. Once you've linked your bank account, all you need to do is select how much you want to deposit, and away you go. One super brilliant advantage of Moomoo is that you don't have to wait the 3 to 5 days for your ACH to clear. Moomoo give you the buying power instantly, so you can trade the same day. Alternatively, you can fund your account with a wire transfer, which is very straightforward, and is performed the same way that all wire transfers are. Moomoo is also a really great platform with early access to initial public offerings, seamless access to Hong Kong stocks, the full extended trading hours, and they're fully registered with the SIPC and FINRA and fully insured with up to $500,000. Guys, be sure to let me know down in the comments below what you think the biggest failing of the SEC actually is. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!